Good morning. My name is Frank Grinnell. I've been advising professional money managers and investing in the stock market for over 20 years. It serves as my day job, but most importantly, it is my absolute passion. On Street Views, I offer my daily viewpoint on the stock market in under 7 minutes. I will cover things like the global macroeconomic picture, the mood of the market, company-specific news, secular trends with some actionable sector and stock calls. I hope my insights are useful to you, whether you are a professional money manager or a passionate investor. At Grinnell Capital, we actively manage dynamic stock and ETF models for financial professionals and their clients, as well as individual investors. If you want to learn more about what we do, send me a note, frank@grinnellcapital.com. You can also find more of my insights on Twitter @GrinnellFrank. And now, today's Street Views. Good morning, happy Thursday, September 8th, 2022. Okay, we got our bounce yesterday, much anticipated, forecasted bounce. Probably see a little follow through, I would think, near term. I don't know how much. Again, just real simple resistance on the S&P is 4,000 with the 50-day moving averages. Futures today, pretty flat, energy up real modestly considering the shellacking it got yesterday. We've been saying it's been acting just real heavy, and sure enough, we've heard from experts that really analyze the energy markets for a living that they believe that Saudi Arabia, the Saudis are really going to try to support $90 Brent. Currently 88, so we'll see how that goes. We've taken exposure down. We are pretty light in the space, lightest we've been in a while, just because it's really hard to pin where this thing goes. I feel like there's just way too many energy nat gas bulls out there, so maybe it's got a little more space to correct. Maybe next week would be an interesting entry point to add some names. So plenty of skepticism out there on the market in general. Goldman Sachs officially called the July, early August lift a bear market rally looking to go lower. BlackRock did something similar. They're not buying the dip in the short term as a global recession is not priced in a consensus global earnings expectations. No, I mean, according to the math we went over the other day, we're looking for sub 160 in S&P 500 earnings. I think current consensus is still something like 240. That's for 22. So I don't know that it goes that low for 22, but I think that's going to be the number to pay attention to. Something well below $200 in earnings for the S&P 500 probably makes sense. But for BlackRock it seems a little, I don't know. Aren't they the king of the passive stuff out there? You just go on the BlackRock. So many financial advisors have their clients' money in BlackRock strategies, super cheap, absolutely no way to protect you on the downside. I don't know. It kind of rings a little like BS to me. We've got all this great stuff, come on in, but when the going gets tough, now we can't protect you. Like they can't just go in and enable some kind of buying of puts or inverse ETFs or something to try to help. I don't know. That seems a little lame. But anyway, Morgan Stanley, home of one of the biggest bears out there, says inflation likely to fall below 8% in August. Sees core CPI peaking this month. That part seems fairly obvious to me. It's the sticky components of CPI, rent, wages. That stuff I think sticks around longer. How fast is that stuff going to come down? How fast? Really, the pace. I think everybody feels pretty comfortable that inflation might be peaking, but how fast is it coming down? That's the big concern. Interesting upgrade on Moderna, mRNA. Deutsche Bank going to buy. It looks like, if you look at the chart, it looks like a good spot to initiate a position if you are so inclined. Stock's cheap. It's always been cheap. 4.7 times forward earnings. I think is all about what's coming up next for these guys as the COVID stuff definitely fading into the background. They got a lot of shots on goal, but stock just continues to act like crap, even though it's cheap. Legacy high growth stocks that have tumbled significantly and been humbled by the market that we're taking a look at right now. PayPal, Netflix, Uber to a lesser extent, PayPal and Netflix more so. Netflix in particular could be interesting with the ad-supported business. Found out recently that Hulu's version of the ad-supported version of their subscription adds another, I think, $10 a month in revenue per sub for the company. I think they pay, the sub pays like $9, and they get another like $10 from the ad business. Pretty interesting if you think about the scale that Netflix could have with something like that. They could end up making more money for those kind of subs than really any of the other subs, which would be pretty wild. That, and they do have the best algo out there, and the stock is relatively inexpensive. So taking a look at that one, technically it looks like it wants to bottom out here. We'll see. And I think that's all I got. Just we're still constructive here near term. I think that the bounce could run a little bit longer, but definitely wouldn't go crazy to deploy a bunch of new capital. Good luck out there. Talk to you soon. By soon, I mean tomorrow.
And now for some important disclosures. Grinnell Capital is a state-registered investment advisor. Services offered by Grinnell Capital can only be offered in certain states where Grinnell Capital is registered or meets required exemptions. Registration does not imply a certain level of skill or training. For additional information about Grinnell Capital, including its services and fees, please review the firm's disclosure statement as set forth on Form ADV and available at no charge at advisorinfo.sec.gov. This podcast is provided for informational purposes only. The information contained herein should not be construed at the provision of personalized advice and is subject to change without notice. This material should not be considered as a solicitation to buy or sell any asset or engage in a particular investment strategy. Investing in securities involves the risk of loss, including loss of principal invested, and may not be suitable for all investors. Past performance is no guarantee of future results. This podcast contains certain forward-looking statements which indicate future possibilities. Actual results may differ materially from the expectations portrayed in such forward-looking statements. As such, there is no guarantee that any views and opinions expressed will come to pass. All expressions of opinion reflect the judgment of Grinnell Capital as of the date of publication and are subject to change without prior notice. This podcast contains information derived from third-party sources. Although we believe these sources to be reliable, we make no representations as to the accuracy of any information prepared by any unaffiliated third party incorporated herein and take no responsibility therefore. This podcast is provided with the understanding that Grinnell Capital is not engaging in rendering legal, accounting, or tax services, and we recommend that you seek out the services of professionals in these aforementioned areas. The principal investment focus of the accelerator model, the strategy, is to achieve strong relative and risk-adjusted returns, primarily by investing and trading in securities issued by companies that focus on the global information, technology, consumer, healthcare, industrial, and infrastructure sectors. These sectors are characterized by robust secular growth, an abundance of both new and maturing product cycles, a high degree of competition that creates the potential for relative winners and losers within a subsector or theme, a high degree of revenues and earnings volatility, rapidly changing sentiment and public perception, significant yet unrealized potential for globalization, and superior relative liquidity. Investment in the strategy is speculative and involves a high degree of risk. The second investment model is called the ignition model. The ignition model is an all-exchange-traded fund, ETF, strategy with an investment objective similar to the accelerator model. This model seeks to capitalize on long-term growth trends experienced by the market leaders in various areas and sectors. The ignition model will also seek ETF investments based on cyclical forces experienced in the U.S. and the global economy. This model is also designed to have the ability to offer some downside protection in the event of significant market stress through investments in ETFs designed to take advantage of market volatility. The strategy's performance can be volatile. Grinnell Capital has total trading authority over the strategy. The use of a single manager applying similar trading programs can mean a lack of diversification and consequently higher risk. For more important disclaimers, please visit our website, grinnellcapital.com.